So I thought I'd get an accountant in to give us some feedback and talk a little bit about the budget and the changes that we've had happen over the past week or so. So I've got Tom Francis here from Gears Sullivan just to tell me a little bit more about what's going on, what it actually all really means. So thanks for coming in, Tom, and having a conversation. I'll probably just ask it really simply, like what are some of the biggest changes that you saw come from the budget and the direction that the government want to take things in that regard?
Yep. I think government set a very clear agenda that they want some change in the property space, and they've done that with the two real headline grabbing ideas, which is a change to the capital gains tax and also a change to how negative gearing is going to work for rental properties. I think it's going to come down to how you've structured your investments on which one's the most impactful for you, but certainly capital gains tax changes have the biggest impact in terms of how wide they go in our economy, because that's applying to all kinds of assets. But negative gearing for taxpayers who've got a rental property in place or are thinking of adding one to their portfolio, that's probably what's causing the most angst at the moment.
Yeah, and so, I mean, what does it mean for the everyday person? Let's just say you're a property investor, you've got one property, maybe you're thinking about selling it, or you're thinking about, do I just keep it in the real long term? Someone who's owned the property already, they talk grandfathering, like just simplify grandfathering a little bit for us.
Yeah, sure. So grandfathering is a fairly common thing in our tax law where it refers to if you've already acted under the old tax legislation and as things were, particularly if you've made investment decisions or structured your affairs in a certain way, you're not going to get punished for doing that by these new laws. So under a grandfathering proposal, you will be allowed to continue to operate under the old laws for either a fixed period of time or until, say, you sell that asset or exit that arrangement. We've had it in lots of areas like superannuation or different dividend rules over the years, so it's not a new concept, but it's potentially the first time we've applied it to negative gearing in particular. So if I was a person who's already got property in my portfolio of investments, the first thing to remember is under the grandfathering rules, there's going to be no immediate change for the treatment of that asset. You are still going to be able to use negative gearing. You're still going to be able to claim your deductions and any loss you make on that rental property against your other income because you are grandfathered into the old system. What is going to change is that if you're someone buying a property between budget night, which was 12th of May, and 30 June 2027, you'll be able to use negative gearing up to the 30th of June 2027, but not beyond that date. If you're someone who buys a property from 1 July 2027, you won't be able to use negative gearing at all. What you will still be able to do is claim deductions against your rental property income. So you can still claim for your rates and your interest costs and all those other things that go into having a property. But if you make a loss on the way through, you've got to carry that loss forward until you have rental profits in the future to deduct it against. That's very similar for any clients who might have been in business and are familiar with the business tax losses if they've got a small business that they're running as a sole trader. What's a little bit unique about this proposal is we're also going to be allowed to deduct any rental losses against the gain on selling that property in the future, which probably brings me naturally to the next point. CGT having such a big change. For years we've had the CGT discount since 1999 as a main pillar of our tax system, and what that did was cut in half the capital gain you made for tax purposes on any asset you've owned for more than 12 months. So for rental properties, that's going to be, pretty much everyone. No one's going to go through the heartache of buying a property and stamp duty and all those bits and pieces only to sell it within 12 months, or very few people are. That resulted in a situation where everyone was getting this CGT discount on their property sales, and going forward it's going to be a much more complicated situation for people that already have a property and a higher tax environment for people that are buying property going forward, or indeed any capital asset. So I think it's going to encourage some different behaviour from investors.
So let's just, we'll go over some of the negative gearing stuff, if you can. Just give us a couple of different examples. Let's say you've got a property owner who's owned a property for 10 years and then a property which is bought from, let's just say it's now, 1st of July, 1st of June, whatever, before these big changes come in. Just give us the difference on the same sort of properties if they were bought then versus now.
Yeah. So Under our grandfathering rule, we've got the existing property, which was purchased 10 years ago, will be allowed to continue with its negative gearing setup if it's got one. So that means that where the costs to operate that property, primarily interest, council rates, etc., where they exceed the rental income that's coming in, you can claim that loss that you're making on the property against any other income in your tax return. Primarily, we see that being salary and wages, or we see it being other investment income, but usually it's a sort of a salary and wage thing. Contrast that to a property that's either purchased now or after 1 July 2017. At most, you'll have access to negative gearing up to the 30th of June 2027. But most likely, if you purchase after 1 July 2027, under these proposals, you won't have access to negative gearing in the same way. You'll still be able to claim your deductions up to the level of income you receive on that property, but any deductions in excess of the income, that loss has got to be carried forward until you do have a rental profit. And a rental profit can either be a profit from operating that property or any other property, or it can be a capital gain made on selling that property or any other property.
You know, let's just say you've bought the property 10 years ago for 300,000. You know, what are their changes going to be likely to see versus someone that buys after budget day, and let's just put a approximate sale date 3 years from now.
Under the old CGT system, anything you held for more than 12 months, you could apply the capital gains tax discount to, which immediately cuts the taxable value of the gain in half. So that's why everyone calls it the 50% discount as a shorthand. Under the new system, there's not going to be any 50% discount, that's gone. And we're going back to the old system from pre-1999 called indexation. And what that does is applies a particular multiple to whatever the property cost you to increase its cost in line with inflation. So if inflation is going up at 3% a year over the time you own the property, then the cost of your property for tax purposes goes up 3% a year. Or in other words, the amount of gain you make is reduced by 3% a year for every year you own it. We had this system for a long time pre-capital gains tax discount. So it's sort of been a tried and tested approach. We do know that, you know, as far as tax integrity works, we can maintain it. But it is a big departure from our existing system. If I look at a property that's already been purchased now, they're going to have some added complexity as well, because a property that was already owned prior to the changeover on 1 July 2027 is going to be taxed under both systems potentially. So the property there will have capital gains tax discount available to it up to 30th of June 2027. And beyond that, it's in the indexation system for how it's taxed. A property purchased on 1 July 2027 or after is solely in the indexation system. So those new properties, that's pretty easy to understand. We'll apply our indexation system, the gains will be what they will be. For these properties that are existing now, which is probably where a lot of the angst is for your clients and mine, there are two methods that are proposed for how those properties are treated. One is that on 30th of June 2027, we go around and get a valuation for a whole lot of properties and work out what their market value is at that date. And the difference between what you paid for the property and that market value, well, that portion of the gain is under the old system, capital gains tax discount. Any gain you make from that market value to an eventual sale is under the new system, indexation. Or you can just do it based on the number of days you hold the property. So if you bought the property on 1 July 2021, for ease of my maths, and then you've held it for 6 years up to the changeover date, and then you hold it for another 6 years after that, and then maybe you make that sale on 30th of June, half of the gain you make will be under the CGT discount system and half will be under the new indexation system. So both could have a better result for the client, and it's going to be down to like the taxpayer or their advisors to run both calculations and see which gives the best result, because you are allowed to pick and choose which method. Both are going to be valid under the budget.
Yeah. So in the old method you can choose, but under the new method you would only have that one option.
Yeah, absolutely correct. Yeah, so that's going to really lock taxpayers into how they're, you know, evaluating investments for those assets purchased after 1 July. I think under both systems, obviously the quality of the asset still rings true as what you should be focused on, because a good property is going to appreciate in value, and if it's not going to appreciate in value, well, you don't have to worry about the tax to begin with. So the tax is always a sign that you have made a good investment. But yeah, like I say, there's just going to be that added layer of complexity for existing investors while we work through that deadline. And given the length of time people tend to hold property for, this could be a feature of our tax system for quite a while yet. So I think we could definitely see a big run on property valuations at 30th of June 2027. Some very, very busy valuers running around the countryside.
Yeah. Well, hopefully, we see some of those appraisals coming through. But in that regard, do you think that the tax department will want licensed valuations or appraisals from agents?
The indication is so far that they'll want a licensed valuation or some kind of higher integrity valuation than just necessarily like a short form agent's appraisal.
Because we can just put whatever price on there,
Yeah.
and some people will probably be trying to use that somewhat to their advantage.
Yeah, 100%. So the integrity measures are something we don't know a lot about yet because we've got no legislation to support the budget. Primarily the budget is the government setting its agenda for tax policy going forward, and they've been pretty clear here that their agenda is to make some changes to the way property is viewed as an investment. What I think we can expect in terms of, like I said, integrity measures is a standard will be arrived at for what's an acceptable valuation, and a standard, and we know we're going to get some kind of maths and formulas to deal with how we calculate these gains from the ATO. That's been promised to us, but I don't personally know how all the valuers in the country are going to suddenly run around and do all this work. The other option is we end up with a whole lot of retroactive valuations, which is not necessarily bad, but not necessarily as good either. So yeah, I think we need to sort of wait and see for how that plays out in terms of who's doing what in the market. But I think from the client's point of view, they need to be aware that, hey, future investments, there's going to be this new system we need to operate under. My existing investment, I'm going to get the benefit of the old system up to 30th of June 2027. After that, I'm going to be in the new system, and I'm probably going to pay tax under both calculation methods if I sell this property in the future.
What about any exemptions? Who's exempt? Are there different avenues to see things that get exemptions?
Yeah. So there are two main exemptions that I see for the average taxpayer, putting aside the very specific items like special disability trusts, child maintenance, widely held trusts. That's not going to affect the majority of people, even though it takes up a lot of pen ink in terms of writing the budget. What we're really seeing as the big exemptions are, one, for superannuation, there's a particular carve out to these changes, and two, for new builds. And I'll talk about superannuation first because it's a lot easier to sort of wrap your head around. They're exempt is the short answer. A superannuation fund, so we're really talking about self-managed superannuation funds here. Property investors that invested through their self-managed superannuation fund don't need to worry about these changes because their super fund will be exempt from them. They'll still continue to receive the 1/3 CGT discount they always got, and they'll be able to use negative gearing going forward. Colloquially, we don't see a lot of negative gearing in self-managed super funds, primarily because there's not the same tax benefit for doing that there, and because the borrowing's a lot tighter in self-managed super funds, so the debts tend to be a bit lower. So it's probably not a major area of concern when writing the budget to go after them. But look, it's a happy circumstance for us, people that have made decisions inside their super fund, which are a lot harder to change than your own personal decisions. They can stay in the existing world. But that does lead us into the more fiddly new build territory. So we can see what government's targeting here with its policy, and that's that they want to increase investment in new housing, which is an admirable approach. We know that we need more housing in this country. We've got a lot of things going well here, but it's hard to buy a house for a lot of classes in our economy. The way they are targeting this is that the concessions that are being wound back will be allowed to stay in place for new builds in terms of negative gearing. So if I own a current house, for example, and I demolish it and build 3 units on the site, I'll still be allowed to claim negative gearing on those 3 new builds when I operate them as a rental property, or all 3 of them as rental properties. And that's because I've increased the number of dwellings on that site. And therefore I've contributed on a net basis to the housing stock. If I were to demolish the same house and only build one new residence there, I won't be able to access negative gearing necessarily because I'm not increasing housing stock. Now this obviously has some interaction with the grandfathering rules and existing properties being allowed to stay in the negative gearing regime, but really thinking about, investment decisions going forward, this is designed to push property investors towards multi-dwelling sites or converting existing housing stock into multi-dwelling sites. Couldn't speak to whether the government wants that to be in a city or in suburbs that are already existing, but it is quite an interesting carve out to say that, hey, there's a real focus now on pushing new housing as something with a real tax concessional environment, whereas previously government were only offering special tax concessions for low cost housing. So we really expanded what's favoured in that regard.
So just as like a, not a specific example, but let's just say somebody now after the budget changes buys a property that can be developed, but it's got an existing, older, house on it, an established property, doesn't matter about the age. They'll get no negative gearing after July 1 next year, 2027. But if that same owner, they don't sell it, but they develop it and they build, say, 3 or 4 new properties, then they'll be able to use negative gearing on each of those 4.
Yeah, that's correct, yeah. And there's some unknown things there. What happens to that loss they built up on the way through? Does that suddenly come into the tax system and they can claim it straight away? We don't know that yet because we don't have the legislation yet. We're still just at the budget stage. But absolutely that is true. As long as you're increasing your dwelling count, it can just be 2. Even if you just built 2 houses on the site, you can enter that negative gearing space and that tax concession is available to you. What was a very interesting carve out to the exemption was that granny flats aren't going to make the cut. So reading between the lines a little bit, they want separately titled housing, and that's the real focus here. There's no mention on whether it's strata title, survey strata, if it has to be whatever, but separately titled lots for people to live in, new house builds. That's what's being pushed by this agenda.
So you can't just like whack up a granny flat and then negatively gear both.
Yeah, no, I wish. Another thing we don't have clarity on is the changes to existing property. So you would put a granny flat in existing property. That seems almost certain that that's not going to be negative gearing allowed by the way the explanations are worded. But also if you just had a multi-home site or 2 houses on the one site, there are some nuances there and some edge cases that we just don't know yet. So my advice to anyone who's got or finds themselves in a situation where they're not quite sure if their plan is going to fall into either camp yet, just take a beat, wait maybe a couple of months to see what legislation starts to filter out, what extra commentary we get from Treasury and from the government, because for changes this big, we are going to talk about it as a nation for months and months and months to come yet. And then we're going to get some legislation and government's going to talk about that for months and months. And we'll arrive at a negotiated position, hopefully before the 30th of June 2027. But it could be quite close to that date, has been in the past.
Yeah, it'll be pretty interesting to see how it all sort of shakes out. So
yeah, we've had plenty of times in the past where we've had budget measures passed on the night before the next budget drops. So we can go very deep into the financial year without getting 100% clarity. Fingers crossed that's not going to happen this time.
Hopefully, yeah. Some of the main questions that I'm getting constantly from people is, should I sell now? Should I hold? What are the implications going to be if I, wait and sell? What do you think I should be doing? What are you saying to your clients? Are there, a specific thing that you're making recommendations on?
Mm-hmm. Yeah, so there's been very similar questions coming through to our office from a whole wide range of clients. And our message to them has been very simple. Firstly, as I've said before, we don't have legislation yet. So we all do need to be a little bit calm in the face of big changes. Anyone who's making a snap decision now is on a bit of a dice roll as to whether they're making the right call or not. Maybe you time the market and win big because you got out first or you got in first, but then again, maybe you time it completely wrong. As accountants, we're not prone to taken on that kind of risk. We prefer to understand the consequences of what's coming first and then make an informed decision. And that's the advice we're giving to our clients as well. So the second thing we're really considering and giving as advice to our clients is, does this asset still stack up when you consider why you invested it in the first place? So when we're investing, we're always looking for high quality assets, and that could be rate of return, maybe expected capital appreciation, maybe it's a really good defensive asset, or maybe it's something you want to add to your portfolio. These are questions that every investor should be asking themselves as they're making these decisions. And we would always say to people, plan for having the assets you want to hold first, and then look at the tax and the structuring side of that investment. How should I hold it? What's the most tax favorable structure I can put this in? How long do I plan to hold this for? And how does that impact those things? If you are starting to make your investment decisions solely based on the tax outcome, you're potentially missing out on the greatest return, which is, hey, this asset's actually got a lot of growth prospect in it, for example. There's good demographics around this property. There's a new school going in, or I'm buying at the right moment because everyone else is panicking about tax law change and I've got capital ready to deploy. I'm going to get in there and do that now. So without telling people, hey, let's invest in this or that, or this asset over that asset, it's easy to put forward the fundamentals, which is pick a good asset first, structure the tax second, and don't allow that order to be flipped. Don't allow tax to drive your investment decisions, because you're going to end up tying yourself in knots trying to save a bit of tax and potentially miss out on the returns that you were chasing after all.
Or buy the wrong asset.
Absolutely. You don't want to be buying at the wrong time. You don't want to be buying the wrong asset. And in my experience, it's always been that the clients that are tying themselves in too many knots suddenly can't maneuver when they need to. Always intention first, and then plan for the tax. Get the right advice at that moment once you've identified that great asset that you want to add to your portfolio.
Thanks for coming in, Tom, and answering some of the questions that I've got. I'm sure there'll probably be a lot more to ask once we see what actually comes out in the legislation. But I think it's been a great help for me, and hopefully a great help for some of the viewers out there. If they just need some help, feel free to reach out. Tom Francis at Gears Sullivan.